There are decades where nothing happens, and there are weeks where decades happen. I'm Mike Smith, and this is The Lowdown. In light of the events this week, I thought we'd look back at our 5 unstoppable mega secular trends. Of our 5 trends, the one that's front and center today is the accelerated transition from fossil fuels to renewable energy and the long-term implication for geopolitics and the U.S. dollar. Now, to sum that up in English, I want to bring in Kevin Lenox. Kevin is a CFA, CFP, and one of our senior portfolio managers here at Avidian. Welcome, Kevin.
Thanks, Mike. Happy to be here. This year has been such a contrast versus last year. And we have the combination of slowing growth, tighter financial conditions, and in the investment committee, we're having really interesting discussions about this environment and what is going on with the business cycle. And this really all got started before the Russia-Ukraine conflict. Sure. So we'll start with the first slide.
Okay.
Mike, my investment process is built around the business cycle framework that focuses on trends in both global economic growth and financial conditions. Now, the reason we're showing you this chart is that I find it extremely helpful in determining whether institutional investors are positioning for a more bullish economic outlook or taking on a much more defensive stance in the U.S. equity and credit markets. In the top section of the chart, the dark blue line shows the relative performance of a basket of economically sensitive cyclical stocks versus defensive stocks. Now, beginning in the middle of November of last year, you can see that defensive stocks began to outperform cyclical stocks. This reflects an expectation of slowing economic growth and investors increasing exposure to companies that have less sensitivity to a slowdown in economic activity like household goods. The orange line shows the relative strength of U.S. consumer discretionary stocks versus consumer staples. It's really the same story here, except more narrowly focused on U.S. consumers in that slowing growth and higher inflation is reducing discretionary funds for leisure activities such as dining out, while still buying essential household staple items like groceries. In my view, this way of looking at the market is much more useful in identifying changes in investor positioning than just looking at the S&P 500, which is the green line. The bottom section of the chart shows the Bloomberg Financial Conditions Index, which financial conditions is basically an umbrella term that reflects various measures of the availability and cost of credit. In fact, most speeches by Federal Reserve governors include the term financial conditions, since how loose or tight financial conditions are will dictate spending, saving, and investment plans for both businesses and households. My long-held belief is that financial conditions, particularly the credit markets, lead both the broader economic cycle as well as the stock market. So the chart shows the financial conditions in the U.S. began to tighten in November, which provided a confirming signal with the rotation to more defensive stocks. Also, it's worth noting that financial conditions have tightened considerably in Europe due to the sharp increases in natural gas prices and the opacity in European bank exposure to the sanctions against Russia. It will take weeks to uncover the credit exposures and knock-on effects from this tidal wave of sanctions, and my expectation is that global financial conditions will remain tight for at least the next few months and will present meaningful headwinds for global growth.
So that's basically kind of like guns and butter, right? I mean, basically the defensive stocks, meaning the things that are going to be required, we're going to want regardless of that. But you talk about cyclicals, I mean, things like, airlines, things like, looking at restaurants and entertainment, those things are going to be, people are going to cut down on those, or at least you're going to see those come out of favor as things are tightening.
Yeah, you look at Darden restaurants and Brinker, I think they're down about 20% just over the last few weeks. So there's inflation, rising costs, and fewer individuals are going to be going to restaurants.
Absolutely.
Because of those higher prices.
I agree. And one of the things we were talking about when the Fed tightens, now we have seen decades of accommodative policy. This is a pivot now, and I think it's very big that we're seeing, for the first time in a long time, a tightening policy, and that's going to create what we're seeing now is this volatility in the stock market.
Yeah. Did you know that yesterday was the last day of QE? their last $4 billion of bond purchases.
We'll
and we
see.
just printed
Really?
7.9% in CPI.
We'll see if it's the last, though, right?
Yeah, and this, so we've had, I think, just a few weeks ago, before this conflict started, Wall Street had built in 8 to 9 successive rate hikes in a point when growth is starting to slow. And now all of a sudden they're backing away from that now.
Well, it is
so
safe to say,
the Fed is in essence trapped.
Absolutely. This is the latest in the cycle they've been where they want to actually start to tighten.
Mike, I want to bring in another slide, which is one of the most widely watched market metrics, which is the spread between the 10-year and 2-year Treasury yields. Since the beginning of the fourth quarter, that spread has flattened from about 1.2% to only 0.26%. Historically, this indicator has one of the most reliable track records of forecasting a recession when the yield curve actually inverts. Now, I want to make this part clear. It is unprecedented for the Fed to begin a rate hiking cycle, as they are on the cusp of, with a yield curve that's this flat. After all, the Fed just officially ended QE this week, and we had a print today of 7.9% in CPI. The bottom section of the chart shows the relative performance of a basket of unsecured consumer finance companies versus the S&P 500. It's an area that I look at for signs of weakness in household budgets. It'll be very interesting to see how well household finances hold up during this period of higher inflation and negative real incomes or wages after inflation.
So would you say that this is probably going to be leading potentially to a Fed error?
Yes. And if you look at the euro dollar market, I don't mean the euro currency versus the dollar, there's a euro dollar market,
Okay.
the deepest, most liquid market in the world. And it's inverted at 2024, which means these rate hikes, they will be shallow and they're going to be turning around and actually cutting rates by 2024. These are real money bets. And as we said, the Fed is trapped.
Trapped.
They're at the zero bound right now. And what can they, inflation, 7.9% print on the CPI. They will try to raise rates. I believe they will next week. That's almost a certainty. They will raise rates as long as financial conditions will let them.
So basically it's like a tight wire act.
Yeah.
Good luck on that.
And they're probably not. They kept rates too low for too long.
And now they're faced with probably no good decision going forward.
Yeah. And that's why, kind of my position is they are trapped. But when push comes to shove, they will choose to support growth as opposed to fight inflation.
Well, I think that's an important thing because I think recently the media has come out and said that their targeted goal, number one, is inflation. But I think that's a good point you just made because that goes back to our portfolios, all the money that we have, management, risk assets, and what the likely response is going to be.
And that's what the gold market is telling you here.
Okay.
It's had a sudden move within just the last few weeks, and it's feeling that they would rather let inflation run hot and take their chances. Demographics are in favor of some sort of a weaker economy and slower growth, less inflation. Robotics, automation, technology all point to a longer-term disinflationary type of trend. And I think they just have to pick their fight, and they're just going to take their chances with inflation, which is something that they did after World War II, actually. So it's not unprecedented. But to start a hiking cycle with already a very flat yield curve is
not a good idea.
Screaming a policy error.
Yeah. So Kevin, I'm getting a lot of calls from clients, a lot of questions, and one of the big questions is, and I want to get your commentary on that, is about the dollar and its world reserve currency status. Many people, the media, the headlines are all talking about we could be losing that world reserve status. What are your thoughts on that, and what are your comments?
That's a good point. And the U.S. dollar has been strengthening this time despite keeping rates at zero. And we are still, despite all the faults in the U.S. economy, we are still the cleanest dirty shirt. As a store of value, the U.S. dollar is still it. And that's just further exemplified by what's going on in Russia, Ukraine. Would you rather own euros or dollars?
At the end of the day, what's the alternative?
Correct. Yeah, and gold, that's not, particularly. It's a good hedge.
Correct.
But in trading terms, it's still the U.S. dollar that accounts for the vast majority of trade around the world, and it has a very important impact on asset allocation. And I've said for a long time, if you get the call on the U.S. dollar right, then the rest of your asset allocation calls are probably going to work out pretty well.
Well, that's why it's one of our big trends.
Yeah, and it's I mentioned before, the flight to quality.
Mm-hmm.
It's happening, as I showed you before, in stocks. It's happening in the bond market, and it also happens in the currency market. And when you see three separate, disparate groups of investors expressing basically the same theme, that to me means a lot from a business cycle perspective and how we should be allocating portfolios.
So Kevin, this week we heard President Biden, he came out and he imposed sanctions on Russia in regards to oil and gas. I thought maybe you could explain, what does that mean? We were getting so many different takes from media, but what does that really mean, and what is the global implications for that?
It's not that much in our case.
Okay.
We about 3% of our imports are Russian oil. So statistically, it's not much.
Yeah.
We can easily make up for that. Although oil-related products,
Okay.
that is about 8%. That's a larger deal, and it's still, I think, unclear exactly whether all of those will be banned or not. But Russia is the largest exporter of oil. Oil is done in dollar terms.
Mm-hmm.
So when we're talking about financial conditions earlier tightening, they tightened so much more after these sanctions started because now there's less dollar liquidity. Now you're seeing rolling margin calls because suddenly now Russian oil is stranded. Shippers don't want to ship it. Insurance companies don't want to insure it. And it's leading to, I see it every day on the Bloomberg terminal, more margin calls, big players getting wiped out, and it's going cross-asset now.
So the knock-on effects from these sanctions,
exactly.
basically.
So we walked into this with, and I've been an oil bull for like a year and a half now. I know. And we had, poor returns for 10 years going in 2020. And a lot of shale business models were horrible, and a lot of private equity, investor money, and bank money just got lit on fire. And that led to just less investment in the group.
People running scared.
CapEx dried up, the layoffs, the downsizing all continued, and then ESG. So you had Wall Street then saying, we don't want to invest in this business. And it's funny when I participate in these portfolio manager conferences around the country, and they're all about ESG, and then it'll flash on to me, and I'm like, actually, I like energy. Here.
You're one of the only one in the room at the time. Now everybody
not
likes
popular, right? And so we created this structural shortage. And now here we are. We take out Russia, the largest exporter, and it's going to take a while to replace that oil. And Europe they're toast short term.
With a 30-40%
they import so much natural gas from Russia. They're dependent on it. And knock-on effects, we talked about that just a second ago. Now, they're going to be importing more natural gas from us. It's going to tighten the natural gas market, and guess what? Our nat gas prices are going higher. And, oh, by the way, food prices are going to go up substantially further because nat gas is an input for fertilizer.
Correct.
And already we're seeing corn farmers reducing the size of their crop in favor of soybean. And reduced wheat as well. And Ukraine is a big source of wheat. So this isn't just an energy story. This is also a food story. And you run the risk of something of another Arab Spring when food prices get too expensive for middle America.
So it's a tiny snowball. It starts off small, rolling down the hill. It just kind of picks up more and more, and that's the effects we're seeing.
It just feels like the politicians just kept trying to come up every single day with what else can we do to punish Russia without really considering the knock-on effects. And there's still a lot of banks in Europe where the opacity of the loan book and exposure is a lot less clear than it is here in the U.S. And we're seeing credit spreads tightening significantly there, and now counterparty risks globally.
So that's liquidity issues.
That's
right?
liquidity. And part of financial conditions. So So we're in a tougher spot right now. We already had global growth slowing.
Yeah.
And then here's still the Federal Reserve saying 6 to 8 rate hikes.
The Federal Reserve area.
They're almost blind to this.
Liquidity issues and, supply chain disruptions even further when we're just getting them back together.
The risks of something bad happen increase when growth slows.
Correct.
Good growth can cover over a lot of other policy errors and mistakes. So we've been focusing on being a little more defensive.
Yeah.
Higher quality assets and hedges. We've had some energy and some other things in the book, infrastructure, things like that can help during times like this.
Well, and at the end of the day, and it's one thing I've been telling people is no one knows what the outcome is going to happen here. There's a lot of uncertainty with the markets pricing in. And while I tell people this is not time to be brave, which means taking on too much risk, but I also say it's not time to crawl in the hole and run to cash. Staying well diversified is your best defense against this longer term.
Absolutely.
So Kevin, we have a lot of clients that are overweighted the energy sector. I mean, most of our clients, they're here in Houston, or they were at some point. Especially now where we've seen energy from a couple years ago in the abyss, now to all-time highs in some instances. What would you recommend right now for those that are overweighted in energy? What type of strategies or what would you recommend that they do?
I think the energy index is up about 70% over the past year. So what started as a tactical overweight to that sector now has become a giant overweight.
Yes.
And in this type of environment, I think it's extremely important to manage risks. So where I've had clients that had a reasonable exposure what I wanted to energy, now many of them sitting well above that. And honestly, I've been suggesting many clients reduce exposure to energy at this point. We know there's going to be concerted political pressure to reduce oil prices one way or another. Heck, we're even talking to Maduro in Venezuela now.
Yeah.
And the Iran nuclear deal all of a sudden came to life potentially and could be done in a week or two. It shows the level of desperation. So politically,
so the move could be quick.
I wouldn't be surprised at all to wake up one morning and there's just a rug pull on energy, one way or another. So buy low, sell high.
Correct.
If you bought back in late 20, early 21, congrats, great trade. Lighten up when prices are very high and you've got a war premium in there on top of it.
And what about those that have held maybe shares for a long period of time? What about capital gains? What are some other strategies that they might consider and ask questions on?
Sure, there are various ways to hedge or create different exposures to reduce the risk and avoid expensive capital gains.
Okay.
So that's beyond the conversation of this show, but there are important conversations to be had with people that have concentrated positions with a low cost basis.
Well, great. Well, I'll tell you what, they could probably get a hold of us to go to our website, avidianwealth.com. Your bio, my bio is there. If they got any questions and maybe kind of follow through, they can get a hold of us and definitely we can help with determining what strategy is best for them.
Absolutely. A lot of clients have a lot of questions right now, and there's bull markets are, great. People confuse brains with the bull market, but there's been a lot of dislocations, and I've come across new people that have just made serious mistakes.
We've seen this before, right?
We have seen it before.
Thanks, Kevin. This has been very informative. And if anyone wants to get a hold of us, they know where to go, avidianwealth.com. Thanks for watching. We'll see you next week.